Central banks print money digitally by creating electronic reserves, not physical cash. This process fuels the economy without ever touching a printing press. Imagine waking up one morning and hearing that your country's central bank has printed billions of dollars overnight. You picture giant machines churning out stacks of crisp banknotes, but that's not what actually happens. In today's financial world, printing money is more metaphorical than mechanical. It's a digital dance, orchestrated by central banks to keep economies humming, especially during times of crisis or slowdown. Most of the money we use today isn't tangible. It exists as numbers on screens, balances in bank accounts, figures in financial systems. When central banks print money, they're usually creating electronic reserves. These are digital entries added to the accounts that commercial banks hold at the central bank. No ink, no paper, just a few keystrokes backed by powerful monetary policy. This process is part of what's called monetary expansion, and it's done through tools like open market operations. Central banks buy government bonds or other financial assets from commercial banks. In return, they credit those banks with newly created reserves. Quantitative easing, a more aggressive form of OMOs, QE, involves large-scale asset purchases to inject liquidity into the financial system. Lowering interest rates. By making borrowing cheaper, central banks encourage spending and investment, indirectly increasing the money supply. Physical money, coins and banknotes, is only a small fraction of the total money supply. It's costly to produce, easy to lose, and hard to track. Digital money, on the other hand, moves instantly, scales easily, and integrates seamlessly with modern banking systems. Plus, most transactions today, from buying coffee to trading stocks, happen electronically. When central banks create digital money, it doesn't go directly into your wallet. Instead, it flows through commercial banks, which then lend it to businesses and consumers. This fuels spending, investment, and job creation. It's like watering the roots of a tree. The leaves don't get wet immediately, but the whole system benefits over time. However, this power comes with responsibility. Inject too much money, and you risk inflation, where prices rise and purchasing power falls. Inject too little, and the economy could stall. That's why central banks constantly monitor indicators like GDP growth, unemployment, and inflation rates to fine-tune their approach. A modern monetary myth. The phrase printing money persists because it's vivid and dramatic. But in reality, central banks are more like coders than printers, writing new lines into the financial system's ledger. It's a quiet, calculated process that shapes everything from mortgage rates to the price of groceries. So next time you hear about money being printed, picture a secure server room, not a printing press. The real magic happens in the cloud, not on paper.